Hello and welcome back to Well Balanced, the podcast brought to you by Vector Wealth Management. I'm Jason Ranallo. Today, we're unpacking a major development in the world of U.S. government debt and what it means for treasuries, mortgage rates, and your financial plan. You may have seen the headlines. Bond rating agency Moody's has downgraded U.S. Treasury bonds from their highest rating of AAA to AA1, a one-notch decrease. Moody stated successive U.S. administrations and Congress have failed to agree on measures to reverse the trend of large annual fiscal deficits and growing interest costs. Now, this downgrade isn't without precedent. The two other major rating agencies, Fitch and S&P, downgraded U.S. debt in 2023 and back in 2011, respectively. Moody's was the last one to hold on to the top-tier AAA rating, one it had maintained since 1917. That's when the U.S. began issuing Liberty bonds to help finance World War I. But today, with federal debt held by the public reaching $36 trillion, concerns are growing. As Moody's puts it, the U.S.'s fiscal performance is likely to deteriorate relative to its own past and compared to other highly rated sovereigns. They estimate that net federal debt could rise to 134% of GDP within the next decade. For context, 20 years ago, that figure was about 40%. Today, it stands around 106%. That's a dramatic upward trend, and it hasn't gone unnoticed by markets or rating agencies. So what's happening with Treasury yields? Here's the interesting part. Despite the downgrade, Treasury yields have remained relatively stable. The 10-year Treasury yield is holding around 4.45%, which is within what many consider a fair value range. And mortgage rates? Mortgage rates tend to track the 10-year Treasury. Right now, the average 30-year fixed mortgage rate is about 6.9%, almost double what it was 5 years ago. That's created a real affordability challenge, especially for first-time homebuyers. In fact, housing affordability is now near multi-decade lows. So what does this all mean for your financial plan? Despite the downgrade, Treasuries can still be a valuable component of a diversified portfolio. They remain highly liquid, globally trusted, and typically provide stability during times of market volatility. In short, we're not concerned about the creditworthiness of the U.S. Treasury market. The U.S. economy is still the largest in the world, and its ability to meet debt obligations remain intact. What are we watching going forward? We're closely monitoring the relationship between 10-year Treasury rates and economic growth. When borrowing costs reflected in Treasury yields outpace the growth rate of the economy for an extended period, it tends to signal rising uncertainty. So where does that leave us? In a word, watchful. While the U.S. credit rating has shifted, our approach hasn't. We remain watchful, not reactive, focused on fundamentals and committed to guiding your investments and financial plan through changing conditions. As always, thanks for listening. Until next time.
Hey, thanks for listening to our podcast. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment